Okay, so if you're new to this channel, I don't do this very often, but kind of the format is I'll give you some opening comments. I'll talk about the economic calendar for the week that just ended on Friday the 17th in this case. And then I'll look forward to the economic calendar for next week. And also in there, I'll talk about markets, and I kind of have closing comments. That's the format of this particular channel. All right, starting out, I spoke last week about Silicon Valley. I said that's a crack. That and really the outcome of that is that the crack has now grown into more cracks, and a lot of moving parts. A lot of the things we don't aren't privy to because they're happening behind closed doors. But something tells me that some of these things are maybe not on the scale yet of 2008, but kind of been expecting this. So we had Silicon Valley, just as a review. We had First Republic Bank, we had Signature Bank, and then just when it looked like the smoke was clearing a little bit, then we had Credit Suisse, which has actually been in a decline for a long period of time. So the reaction seemed a little bit I don't know, excessive for what happened, but people get sensitive at this point. And I think that's in essence what we're seeing now. So let's take a look at what happened this week along that line. And then we had the president came out and spoke at 9 o'clock on Monday morning about the situation with Silicon Valley. And you had a whole slew of other politicians and cabinet members and people come out. Oh, the banking sector is safe. Well, just remember, if you've been around long enough, 2007, 2006, 2008, all saying the same thing. And then we had at 11:30 on Monday, we also had a closed door Fed emergency meeting. And so that was kind of how the week started. And it was what started out where you expected maybe things would start to recover from a market perspective. All of this overtook the markets and things got ugly really fast. And even though on Tuesday morning, if you look here, we have the core inflation rate came out at 5.5%, which was in line with the expectations and probably normally would have driven the markets higher at that juncture. You know, expectation was 5.5, came out 5.5. Then we had the year over year was 6.4%. Was the previous. And you can see, you know, it's all sliding down. So you would have thought that, you know, the markets would react, but they didn't care. It just didn't matter at that point because everybody's focus now became on the banking sector. Everybody's flinching from 2008, and you can't blame people, you know, from that particular perspective. You know, then the rest of the week, you know, proceeded. We had Wednesday, we had 30-year mortgage rate came out a little bit less. I think we're going to see precipitous drop when we watch the mortgage rate, 30-year mortgage rate come out next week. PPI, you know, was down 0.1, which you would have thought would have driven the markets up to. Retail sales down 0.4%. Good news. You know, if we were just focused on the Fed like everybody has been. The New York Empire State Manufacturing Index down 24.6, and you know it's been negative now for a while and with some pretty ugly numbers, and so you slowing down of the economy again. Good news for the Fed, but it just didn't matter because everybody was focused on the banks. And then Thursday, building permits came in better than expected. Housing starts were better than expected. Initial jobless gains were better than expected, but the market went up. So there's almost no rhyme or reason associated with what's happening in the marketplace. It's just chaos right now. But we had, an unbelievable day on Thursday, which we'll take a look at here in just a minute. And then this morning we had the Michigan consumer sentiment came in at 63.4 at 10. I thought that might do something in the markets, but it kind of went down. But after yesterday's big run up, it's not surprising that today was kind of a, at least take a breath day. Okay, let's take a look at the markets. And I'm not going to start with the put call ratio. Let's start with the Dow Jones, and you can just see the last 5 days here. Down, down. These are lines here that I've had for a while on the Dow Jones. And, we broke out of it. Now we're flirting with going back into the bear market, below this line. I'll make some comments about that a little bit later. And then the SPY, we've had this thing. We kind of have this uptrend going. It broke. Started to get a little bit concerned here when this downtrend kind of put us back into the bear market. Now, then we popped back up above it. Then we went down. I mean, it is psycho. It really is a psycho market. And, people are, it's hard to, it's difficult if you're not a trader. If you're an investor, you'd be going nuts if you watch this stuff every day, which hopefully, I wish more people would get involved with it, but, they need to understand kind of what's going on. So then we had this big day here, that this was, 388 to 3. I mean, this was a big run on Thursday, and then today the expectation was that we have some, but you have this big bullish engulfing candle here, which should bode well. My expectation, I'll talk about here in my closing comments, is that the tide is turning, and so we'll talk about that, or potentially is turning. Okay, so what else we want to look at? So this is the reason why we expect the 30-year mortgage to go down, the 10-year, kind of the harbinger of, all loan rates has dropped. We were worried about it breaking through the 4%. Now we're talking about we break through this level here at 3.4%. Then, you're going to see tech stocks even run more than what they have been. And then you have the DXY that we were worried about going up over, 105.5, 106 in that area. And now we're back to this kind of another critical point here at about 103.5. And again, been tapping on it a few times, breaks, goes down. After that, I have to go back in time to see, what other levels we could potentially break. But let's take it one at a time. We break, the dollar starts to go down. Now remember, this is a double-edged sword on, the dollar index typically means good things for things like precious metals, even the markets. The U.S. dollar, which is what the DXY, the U.S. dollar index, monitors, basically is involved with is, that's the good news, I guess. And then the bad news is if it breaks these things and starts heading down, then the price of everything that we purchase is going to go up. So, there's always a downside. We see crude is collapsing, has been collapsing ever since it broke this cone here back broke it on Tuesday and just continued down. I think David Hunter is expecting this thing to go maybe lower into the 60s. I don't follow oil that much, at least at this point. I will a little bit later probably, but right now go, and if it makes its way into the 60s, I think David Hunter thinks it's then going to go up around somewhere in the middle 80s or so, going up there. And then the VIX, of course, spiked up again today. It's again up, down, up, down, up, down. It's over 24, which makes the options a bit more expensive. And there's more volatility. You can just tell if you watch the ticker during the day. If you happen to take a look at it, things go up and down in $3, $4 increments, where normally it's 10 or 20 cents. The put call ratio went down, and it's kind of surprising that it did, and I'll share with why after I cover the economic calendar for next week. And so next week, existing home sales, I'm on Tuesday, but the whole week's going to be made up of this 2:00 meeting with the FOMC economic projections, and we'll see what happens. We'll get a new read on the 30-year mortgage rate, but the news is this. It's going to all be about that and what kind of explanation we get. We're going to get a full, a half a point, a quarter point, no raise. I don't think half a point's on the tables after these bank collapses. So the expectation is a quarter point. I'm curious if they do not raise the rate, what the reaction will be. I don't think there's going to be a severe reaction at a quarter point. I think it'll be more of a reaction if they don't raise, if they pause at this point. But I don't know what they see. The Fed, obviously, all these closed door meetings and everything, they're on lockdown right now, so you're not getting any information out of them. There's no speeches being done. So I'm curious if they pause, then that people will read into this, right? So if they pause, it means that the banks are in worse shape than we thought, and we're going to put more banks in there, which could be true anyway. They do a quarter point. It's kind of the expectation. I'd say on Friday last week, I would have expected, and even Monday, would have expected a pause because of the situation. But if it's bad, then you could expect a pause. If they lowered it, which I think is not on the table at all, if they started cutting Fed funds rate, then I think that would tank the market, just because that means that they're seeing something and it's going to bring up a lot more questions. We'll see what happens on Wednesday when Chairman Powell, Fed Chairman Powell, does his thing. So then Thursday we got building permits, we've got initial jobless claims, got new home sales. Friday we have durable goods that could move the market, but all the reactions going to be from this 2:00 meeting on the Fed rate decision, what they decide to do, from a projection standpoint. And everybody's thinking they're going to do a quarter point. That's the consensus that would put us at 5%. Whew. It's going to be an interesting week next week. I don't think Monday, Tuesday. I think everybody's just setting themselves up for Wednesday. Okay, so kind of the final comment. So it's going to have to do with the sentiment right now. And I'm going to give you my read. This is not intended to be any type of trading call. It's just, this is my opinion about where I think things go. You tell on Wednesday night or Thursday morning, we had this investor sentiment survey at 48.4%, which I love because that means everybody's, fearful, meaning I'm greedy here, and that's I'm it's where I prefer to have people be, is that they're being bearish right now, very low on the bullish, some neutral, but look at that. I mean, that's pretty bearish for investors. And but it doesn't necessarily. So let me go back to this, to the put call ratio. I would have expected this to stay up here, more puts, if people are that bearish. But it could be just because today was got slammed down, and after yesterday's big run up, the people are expecting that the market will recover. But you would think that would change this report, which is extreme fear. With I think I saw it 23 today, maybe certainly 24. I definitely saw it ended at 25. So we're in the extreme fear category. If we look at this thing over time, we're down there. Compared to what we were doing last year, last year in June and late September, all those things where people were panicking. So that's kind of the expectation of what the investors have. So it's very bearish, and that's why the put call ratio doesn't necessarily line up with that in my mind. But here's my read. And again, I want to make it clear, it's not a trading call, but it's just my expectation. For a long time, when I started to look at these markets, and let's just go back to the SPY, because I think it's a good representation of things that are going on. David Hunter's increase here to records. Once it got back into this bearish market, I really started to question, and I even kind of drew a line in the sand here. If it got below 377-ish, maybe 375 in that area, I thought, well, that's the end of that, and Peter Schiff's going to be right. Then we had this big gap up and run up, and then we had it run down on Wednesday. All this having to do with the banking, and I understand that. But then we had this candle. I mean, it really ran. I mean, that's a huge candle for one day. It's over $10 a share of the SPY going up in one day. You don't find those. Usually you find them on the way down, but you don't find them on the way up very often. But that just shows some of the volatility that we have. And then today, I had expected at least that the market would go down. It was kind of a blah day. And I think everything's just going to kind of be, it might go up because we had this down day, probably will go up on Monday, Tuesday. At least that would be my expectation. But I think everything is going to be pretty muted until we hear from Powell on Wednesday about the rate hike decision, and then his comments after that. So that's kind of expectation, what it'll run up to. We definitely have, with rates coming down and on the 10-year and the dollar starting to collapse a little bit, all these are good things for the stocks. And so, I there's certainly a window here, and I have to say, it's a window, and the window is getting bigger. That now, expectation is that the pause will come earlier rather than later. I'm not expecting it to come on Wednesday like most people aren't expecting the pause to come on Wednesday. Still expecting a quarter point increase, and but the comments will certainly sway the markets, one way or the other. And I don't know that Powell can afford to come out and make a lot of negative comments at this point, because I think he's got other concerns right now, things that you and I just don't see. And so I do believe that the David Hunter forecast is back on the table big time, and that whether his expectations could go down to like 365. I think if it gets below, what is this, 375-ish, a little, or 374, high 374.80 something, it breaks that. I'm still of the mind that kind of cancels unless it just goes down and comes back up immediately. That would be something different. But my expectation is that this thing is going to start to ride, and because the rates have come down, tech is starting to, or has been actually leading this thing out of it. I mean, if you watch, NVIDIA and that stock, I mean, it's incredible. Let's just pull it up for a second. Look at that run. Now, I think it's going to have to take a breather here after all of this. Of course, I've been waiting for it to take a breather for a while. I got this gap up, so we got this gap to fill. We've got a whole bunch of stuff happening with NVIDIA, but it's certainly leading the techs, and even Apple today, it's hanging in there at 155, I believe. I don't know what it finished the day. Okay, so 155, right around that area. So it's hanging in there. Now we get double top. I mean, there's so many different things. My expectation is this thing will start to go back up with the interest rates coming down. The more these 10-year yield on the government bonds will affect the interest rates and so forth. So I'm looking for the turn, folks. I really am. I think this thing will start to turn up from here. There is a possibility that it goes back down here. If it went, I think David Hunter basically said 365, which is way down. It can't stay there. I mean, if it closes down there, if it goes down there on a, during the day and then pops back up, okay, I'm okay with that, having a wick way down there. But I think if you go, let me move this just a little bit, right there, was that 374.63, break this wick here, below that, close below it for 2 or 3 days, then that will have me rethink everything. But my expectation is that this thing will start to run up, and I think that we're going to start hearing different messages from Powell, because he's got now, not only is he fighting government, I mean, think about this, he's raising rates, government spending like mad, and now they've bailed out basically some of the banks that have been in trouble. And to what extent, we don't even know, other than they bailed out the depositors, which I'm not for. I know there's all types of controversy associated with that, but $250,000 FDIC, you got to know that. And I talked about that a little bit last week. So that's what I wanted to cover this week. And remember, there is always a better way.